Okay, so we will get rolling. Welcome to our virtual webinars. We've been doing these virtually since COVID started, so thank you for making time to join us. I am Katie Anderson. I am the founding owner of Appearing Management Group, and we are going to be talking today about understanding your association financials. So, and a lot of what we discuss as a management company is really to provide you with the tools as a board member on, how to be a board member. What is it that you're looking at when we're sending you information? And so it's not our goal for you to be an expert by any means on how to be a CPA or understand sort of the transactional parts of the financials. Our goal for you today is to really understand the basics. What are the reports that we're sending you on a monthly basis? What do those reports show you as a board member? What are some of the things that you should be looking at in those reports? Understanding sort of those key indications. And we always like to go through talking a little bit about how to gauge or understand your role on the board on how to spot and prevent fraud. There's a lot of checks and balances that we as a company have put into place to separate duties, but it's something we always like to make you aware of. If you were ever to go to another management company, it's always really good information for you to understand what are some of those areas for community associations that can be potential risk factors. So that's what we're going to go over today. If you have questions as we go through the presentation, I am monitoring the chat, so feel free to use the chat function if you have a question that comes up through the presentation. And we will save some time at the end of the presentation to make sure that you can ask me your live questions. So feel free to save your questions for the end. And if you have them throughout the presentation, please make sure and use the chat. But the items on the screen are what we're going to be going over this afternoon. So a few key takeaways, and just to note, you don't have to write down this stuff verbatim or take screenshots throughout. We're going to send you this presentation after our session today in a PDF. So feel free to jot down some things that maybe aren't appearing on the slides, but don't feel like you have to jot down everything on those slides because we will send it out to all the participants following today's session. A couple of things that we are going to touch base on. These are just some key takeaways we hope that you all walk away with today. Understanding your role as a board member, how to act as an advisor for your community, understanding the different reports that we're going to be sending to you, and how to read those. So that, that's really what we hope you walk away with today. So let's start with some financial basics. These are sort of the foundation for you as a community, both in your role as a board member, but also in your role as an owner to kind of understand how these things flow. So for your community, you are a incorporated business with the state of Oregon. You have nonprofit status, which allows you a little bit of flexibility in how you bring that money in, but provides some guardrails on how it's spent and what you're responsible to do. And all of that starts with your budget. Your budget sort of lays that foundation for your community in a lot of ways. It is developed annually, and it's approved by your board and then noticed to your owners. And that foundation sets the tone for, what assessments are coming in, what vendors you're hiring, what projects you're going to be taking on over the coming years. It lays that foundation to allow for your community to operate. And so the vast majority of the, sort of initial parts of the budget are done by our staff, and we'll go into that a little bit greater detail. And following your budget, or in conjunction in a lot of ways with your budget, you have your reserves, and your budget looks at anything that is on an annual basis, and your reserves look at anything that is from 2 to 30 years. And your annual budget is your landscape contractor, your insurance, your management contracts, those types of things you're paying every month or annually. And your reserves is the maintenance and the oversight of the common area that you own and what that cost is going to look like for those components from 2 to 30 years. And so these studies are facilitated by professionals and they are reviewed by your board of directors annually. Doesn't mean you have to update those reserve studies every year, but they're reviewed. And so that sets the tone for how much money you have to set aside to make sure you can continue to maintain those properties. And then your financial and your monthly reporting is really, how are those two things performing? Based off the assumptions we made in our budget, are we on track with our expenses? Do we anticipate needing more income or going over our expenses throughout the year? How are we performing both from an operating standpoint and from a reserve standpoint? And those financials are reconciled monthly, sent to you monthly. There's a more comprehensive report that we provide quarterly that sort of explains any potential variances or things of that nature. And the financial reports understand are really developed from a perspective of transactional accounting. We don't, Appearing doesn't perform your tax filings or your financial reviews. We coordinate that with an outside CPA firm. And so those monthly reports are performed by us in-house, and then your annual reporting is performed by an outside CPA firm. And depending upon the size of your community, there's different regulations that are dictated there. So what are some of the reporting factors? What are some of the things that are going to play into what you see on a financial and your role as a board member? So there are some state statutes to understand from a financial perspective. The states require that you have a reserve study, that you look at that reserve study every year, that you notify your ownership 30 days prior to a new assessment going into effect of that new assessment, and that you are responsible for making sure that you perform a financial review if you are intaking over $75,000 a year in income. And those are most of the financial requirements in the state statutes. There is also some additional requirements that were voted into law last year regarding fidelity bonding. That has to do with ensuring your association against fraud or against any theft. And we can go over the specifics for you and your community if you're curious about what fidelity bonds you have, what dishonesty information you have. But from a state statute requirement, there's not a ton of written law. Most of the guidelines and guardrails for your community regarding your finances are going to be in your governing documents. And your governing documents are going to lay out a few things. What you're responsible for. So when we start to talk about budgets or how to draft those budgets, we're going to start with a foundation of what do your CC&Rs say that you own and what do your CC&Rs say that you're responsible for. And so those governing documents are that starting place. And then the next question that we go to when we are talking about that budget process is, what are the owner's expectations? This can come into play if you are in a community where you have front yard maintenance. Your owners may have an expectation that the quality of that service is more of a manicured than just a maintenance. A maintenance contract with the landscaper may be more sort of mow and blow, and that's going to be a lower cost. Whereas if they want it to be supremely manicured, you might need to increase the scope of that contract. So when we start to talk about how to create those budgets, you're starting with the requirements in the state statutes and you're working your way down. What do our governing documents say we're responsible to maintain? Then what are our owners' expectations? And are we meeting those expectations by how we've laid out the contracts and the scopes? And then you start with building those expenses. The expenses then ultimately become the income that you need to bring in. The budgets are always balanced. We don't create budgets that show a negative unless you have some understanding on where that income is going to come from. On a rare occasion, communities might have some excess retained operating earning from the prior year that we're rolling over. That would be really the only instance that you would not reflect that the exact expense is becoming your exact income. There is a few areas of miscellaneous income that can be budgeted, but the association doesn't really have revenue streams that come in to offset those expenses. And then you have your operating versus your reserve budget. And the reason that your board looks at those reserves every year is to make sure, do we need to increase that contribution in order to stay current with what we need for those future contributions. And we'll go into a little bit greater detail as to what that reserve study looks like here in just a little bit. Some best practices that are helpful to understand when we are talking about how we approach budgets is that we're looking at a 12-month period. When we establish the budget, we are looking at your prior year actuals and looking at any forecasted increases. So we're talking to your insurance company and understanding what is that increase going to look like for next year. We're calling the utility companies and making sure we know what the submitted proposed increases are for next year. We're having conversations with your contractors on are their contracts going to stay the same? Are those numbers going to stay the same? And part of that is going to be a board conversation to try and determine, how often you should be bidding out those contracts for your contractors, how often you should be looking at the competitiveness, for lack of a better word, of how your community is approaching your contracted services. So Kathy, it looks like you're having a hard time seeing the slides. Can everybody else see the slides on the screen, or are you all only seeing me?
I can see just fine.
Okay, perfect. So the board really has oversight over what that competitive bidding process looks like. That ultimately, do you want to bid out your contracts every other year? Do you want to bid them out every 3 years? And maybe you have a really great contractor that you're very satisfied with and you don't want to bid that out. There isn't a necessity or requirement that says how often you do. It's just something that the board should be on the same page about and potentially discuss. This is kind of a good example of what your budget is going to look like. Every community is going to be different based off of what your common areas are, but this is the general format for how we structure budgets. You're going to have your 12 months worth of expenses. You're going to have your total annual budget. You're going to have your assessment comparison, and you're going to have your categories. And the categories and your general ledger are ultimately then going to line up with what your monthly reporting looks like. But this is the basic of what a budget's going to look like. The more complex your community, the more accounts you may have, the more categories that you might have. If you have a pool, we're going to sort of group that together. If you've got a clubhouse, we're going to group that together, really so that you can see and track those expenses and make sure we've got a good handle on, do we understand what those expenses are? Are we tracking with that? Is there a variance? Is there something that's kind of out of whack? So this is generally what your budget is going to look like. This particular example that we pulled in, the community pays for water. So, they have units that have that expense and they have some units that don't have expenses. So every community really is going to look unique in what your budget looks like, but this is the general format that you're going to see from our managers. And the bulk of the work going into the budget happens with our managers sort of starting in July. They're looking at your reserves. Does the report need to be updated? Engaging with the board on that direction, putting together these draft budgets, and then you'll start to see these draft budgets in September. So for some of you, this process is kind of fresh in your mind because we just went through this and you probably approved your budget October, November timeframe, and then that was all sent out to the owners. And so that process sort of starts with our managers in the summertime. So are there any shared expenses, for example, the website? Shared expenses in what regard, Stephen? Shared expenses with ownership or shared expenses amongst our clients? Maybe you could clarify what you mean by shared. So what I have up here on the screen is a really simplistic example of what a replacement reserve looks like. And so when we look at replacement reserves, we, again, start with the foundation of your governing documents. What are you responsible for? And then we go into sort of quantifying those common areas. So if you own your own roads, we are going to determine the total quantity of those roads, when were they installed, what's the useful life of those roads, and then what is the replacement value. And what that analysis provides your board and your community is an inventory of all of your common area, what the expected useful life is, what the cost of replacing that is. So based off of that useful life, how much money do you have to set aside to ensure that you have enough money when you're ready to perform that maintenance in an account? And roads are kind of an easy example. The general life of a span of a road is 20 years. And then you're going to have elements of maintenance that go along with that. So you're going to have the replacement of those roads in 20 years. You're going to have the seal coat every 5 to 7 years in there. So you're going to have costs associated with that future replacement in order to make sure that it's maintained down the road. And what that then impacts is ideally every single year you're setting aside a portion of that future replacement so you have those dollars when you need them. Your reserve study, from a statutory perspective, what's required is that your reserve study has to be looked at every year. And what that means is that your board of directors needs to pull that study out when you're looking at your budget and make sure that the assumptions that you've made in that study still make sense. There is not a hard, fast rule on how often the reserve study needs to be updated in its entirety. Generally speaking, for a simpler community where you may only have a handful of components, you should be updating that study every 3 to 5 years, just to make sure that current costs are incorporated into that study. But if you have a very basic list of components, it's not necessarily required that you pay for an update annually. It is important that you look at that study as a board and you make sure that it still makes sense. Are the assumptions that we're making still valid? One of the things that I think has the biggest fluctuation for communities is roads, because it is somewhat dependent upon the cost of oil. And so that in itself can have a big fluctuation. Depending on how far out those elements are coming up will kind of dictate how often you are wanting to update that. So if you have questions about how often should your specific community potentially update your reserves, that's a fantastic conversation to have with your manager, because they can look at the list of components and the complexity or simplicity of your community and give you a recommendation. Here's how often you should sort of schedule that in the cycle of things to update. So, moving into sort of the types of accounting. So you have your statutory requirements, you have your governing document requirements. From your governing documents, we establish your budget, we establish your reserve study, which sets your assessments. And that then rolls into sort of the transactional part of what your community is doing as a business. So as a business, you are making sure that you are complying with generally accepted practices, and you have essentially contracted away that obligation by hiring us, making sure that we are creating checks and balances. And those are sort of tested when we do our financial reviews and our audits with your communities every year. And it's important to understand how we develop your financial statements. And so there are 3 sort of basic forms of accounting practices. You have your cash-based accounting, which cash-based accounting is booking your income and your expenses when they happen. So when you receive assessments, you're booking them, and when you get an invoice, you're booking them. That would create a little bit of challenges if we did fully cash accounting for communities, because you would have a difficult time forecasting your income. And so modified cash accounting is how we produce all financials. And modified cash accounting is partial cash and partial accrual. And what is cash-based is your expense. So when we receive your invoices, we are booking those invoices and paying those invoices. And when your assessments are based on accrual. And so based off of how the frequency in which your community has set your assessments to be billed, we are accruing that income for you. If it's monthly, if it's quarterly, semi-annually or annually, we are booking the full amount of those of that income in your accounts receivable based off of that frequency. And full accrual would be that we are accruing your income and we are accruing your expenses. It takes a bit more time and doesn't necessarily provide a great amount of benefit to your community just due to the simple nature of the transactions you're dealing with. And so the time involved in accrual isn't necessary for your organization. So what you should understand is that your income is accrued and your expenses are cash. And what that then means is, for you to understand where we are from a financial perspective, you have to be able to compare a couple of reports. And so we're going to talk about what those reports are. So the first is your balance sheet. Your balance sheet is going to provide you a summary of your community's financial position. And your balance sheet is going to be broken into three parts. It's going to be broken into your assets, your liabilities, and your equities. And your assets are your cash on hand and any future income you anticipate receiving. So your accounts receivable. It's going to give you all of your bank balances, and then it's also going to give you your accounts receivable balance. How much is outstanding for owner assessments, for reserve assessments, late fees, interest, design review deposits, things of that nature. Now, the balance sheet is not going to provide you the detail on that. Your aged owner balance is going to provide you the detail on it, but it's going to show you what that cash position looks like. It's also going to show you your liabilities. And the liabilities for a community association are going to be accounts payable. So at the end of the month, if we close out your books and there were some outstanding invoices that need to be paid, it's going to show you that those are a liability, because those are transactions that you are still obligated as a corporation to make sure are paid. And then your prepaid assessments. And the reason that prepaid assessments are classified as a liability is that they are not assets of the community until they become due for that owner. And so if you have an owner, for example, that may pay an entire year's worth of assessments in January, they just don't want to have to worry about sending a monthly check. Every month we move a portion of that from your prepaid assessments over to your assets. And so the definition under generally accepted practices is that those are a liability, because if you ever, if you disbanded your association, you would essentially have to pay that money back. The likelihood of you disbanding the association is probably fairly slim, but good for you to understand why that's recorded on your balance sheet as a liability. And then your member equity is, essentially the cumulative net income factored after you look at your assets and your liability. And so that's going to adjust every statement period. And it's also going to take into account any prior retained earnings that your community may have accumulated is going to be reflected in that member equity section of your balance sheet. And then you have your income statement, and your income statement, provides a record for your community. It's what's going to be sent to the board every month that says, here's all the transactions that happened this month, and here's how we're tracking year to date. And that income statement is going to provide you with an idea of, are we on track with our net income based off of the assumptions that we have made in our budget? Or are there key areas where we are seeing that those expenses are exceeding what we anticipated? Quarterly, our managers are going to provide you with a summary report on your financials. They're going to explain those variances, especially the significant ones, to you as a board member so that you understand, what it is that you're seeing. And so that quarterly reconciliation by our managers helps provide some context to those numbers. But if you get those reports in the interim in between and you ever have a question, feel free to email your manager. I'm seeing that the landscape maintenance budget is over budget by $2,500. Can you provide me with some context for this? Included in your monthly reports, you know, if you as a board member, if you're not the treasurer, if you are just a officer, another officer or a director at large, if you don't look at any other report in that document, look at your balance sheet and look at your income statement. If you at least review those two things as a board member, you're going to have a good idea for the financial position for your community. If you're a treasurer for your community, what we would recommend is that you look at it, you know, you look at these 5 reports. You look at the statement and income, you're looking at the aged owner report, you're looking at that payables report. You know, do we have outstanding accounts payable that we don't have enough cash flow as a community to be paying? The trial balance is going to provide you with a detail of everything that happened during that period. So it's going to show you everything that occurred for the last month in every general ledger account, and it's going to provide you that detail. So if you're looking at the income statement and saying, I wonder why we're over budget in this area, you can go to that trial balance or that general ledger detail, and it's going to show you everything that occurred in that period. That might answer your questions. There may be things that happen in prior periods that detail is not going to be reflected on that report. So you still might have to reach out to your manager, but that trial balance is going to give you everything that occurred in that period in detail. And then your bank reconciliations. Always make sure that you are looking at those bank reconciliations. It still is a little bit amazing to me when we take over some communities and that the board has never seen a bank reconciliation. So your bank reconciliation is going to show you the reconciled balances, what your statement balance was and what the reconciled balance is given anything outstanding. It's going to list the outstanding transactions on that report, and your bank statement is always attached to that for you to compare. Does the income statement only include assessments actually received? So no, your income statement is accrued for the income. And so your income statement is just going to show the total assessments posted to the owner's account. So you're generally not going to see a variance in your income on an income statement because that's an accrued amount. You know, we've factored in what the total assessment is based off the income you need. So you're generally not going to see any variances in that regard. What you have to compare in order to understand where you're tracking on your income received is that aged owner balance and your balance sheet. And so your balance sheet is going to give you the total amount of AR outstanding, and that is going to match your aged owner balance. And so, for example, if you have $10,000 worth of assessment income coming in every month, your income statement is going to show $10,000 posted to your income. To determine where you're tracking on receiving your income, you would look at your balance sheet and say, okay, we have $2,000 outstanding in owner accounts. And then your detailed aged owner report is going to tell you who is making up that $2,000. And a general rule of thumb is that we don't want delinquencies really to exceed 5% in a community, or you could potentially have a cash flow problem and we start to look at bad debt. Really haven't seen any of that occur since I would say 2009, 10, 11 was kind of the last time we really saw delinquency rates that high. We haven't seen a spike in delinquency rates really since COVID occurred. It's something we're paying pretty close attention to. Few communities that may have more rentals have seen a little bit of an uptick, but for the most part, the comparison of those reports will be required due to the nature of your income being accrued. When you are reviewing the reports, a few things as a board member that you are going to want to be looking for is how are we doing with cash? Do we have enough cash on hand to make sure that our bills are getting paid and that our owners are paying their assessments? Do we have enough long-term investments to make sure we can take care of our reserves and that we can keep our association common areas maintained? And where are we from a delinquency standpoint? These 3 things are important for the board to understand because they impact the decisions that you're making as a board. If you want to go out and hire a new vendor and that vendor costs more, if you don't have the cash on hand to do that, then that's going to be difficult for the board to make that decision. If you want to take care of a maintenance item that might be earlier than your reserves anticipated it to be, you have to know that you have the cash on hand to do those types of things. And when we're looking at your budget, that delinquency really plays into, do we have a potential, indication that that delinquency goes up? Because the unfortunate part of being in a community association is that if you have a handful of your neighbors that are not paying their assessments, the only way to make up that shortfall is by the other owners sort of covering some of that bad debt until it can be collected. And so these are the sort of the major factors that we're looking at, and the major factors that you as board members should be aware of. Understanding some banking standards. As kind of indicated in earlier, the statutes do have some requirements on how you're opening accounts and placement of funds. So operating funds must be separated from reserve funds. And if we're your management company, that's already being taken care of. We make sure that we have operating and reserve accounts for every client, and that those funds are being separated into those accounts. Your operating account is probably going to be a sort of a high transaction account. And so that is going to be a basic checking account that has, no sort of low or no interest bearing on it. Your reserves are going to be money market accounts, unless, we do have some communities that have high transaction reserve. They're paying more than 5 checks a month out of their reserves. And so occasionally they have to have 2 reserves. But in most instances, your reserves is going to be a money market. We are restricted by federal law how many checks can be cut out of those money market accounts on a monthly basis. And so if you're under 5, you're earning small amount of interest on your money right now. Interest rates haven't been great for a lot of years, so there's not too much that we can do on that part, but you are earning on those reserve dollars. Investment principles it's important to understand that from a statute perspective, you're required to make sure that anywhere you place association dollars, that it's secured from a principal perspective. So it seems like common sense, but just to make sure everybody understands, you can't go play the stock market with the community's money to try and increase the gains. Anything that you pursue from an investment standpoint for the community has to be principally secured. So you're somewhat limited into money market, CDs, treasury bonds. Not fantastic market right now by any sense for trying to capture some gains on that, but there are federal and state requirements on how you handle in your fiduciary duties for those dollars. We also employ lockboxing services to sort of separate duties. And so sometimes as a board member, you're going to get that question of like, why did you guys hire a company from San Francisco? Well, you didn't hire a company from San Francisco. We're based here in Central Oregon, but our bank uses a lockbox in San Francisco. And so what that means is that your owners send their payments to that lockbox. Checks are not handled here in our office, and there's an automatic process for those to be scanned in with the coupon, and we get electronic files of those payments every day. It is the quickest and most secure way that we can make sure that those payments are handled, and we don't have any sort of liability or risk for the financial information that may be coming through our office. So we don't store bank account information. We don't store credit card information. We don't keep any of that sort of within our management firm. And then, it's always, from a banking perspective, important to understand that should your community, come to a crossroads of maybe you have a maintenance project that needs to be taken care of and you don't have enough cash for that, there is the ability to potentially bridge some of those gaps and seek some loans. Lending through the association world is fairly easy, but it does require, and in most instances that associations increase their assessments in order to meet the payment obligations of that. So it's not always a perfect example. It's not always a perfect option. But if you are, as a community, experiencing some cash flow issues, there's really 2 levers to pull: special assessments or trying to find a loan that could potentially bridge those gaps. So as I mentioned earlier, a couple of things that we always like to educate our boards on is what are some things that you should be looking at when you're looking at the financials. Should you ever choose to leave our company and go to somewhere else, from an industry perspective, these are important things for any board member to understand. And, if you're starting to see a steady decline in the amount of cash that you have on hand, that is something that you as a board member need to understand why. Are we seeing an increase in assessments go up? Are we seeing an expense sort of get wildly out of control? What are the reasons behind that decline? Significant or unexplained differences between actual budget and figures, those are things that you should be concerned about. Most of our communities don't have treasurers that want to be actively involved in the bank account, but whatever your community wants as far as view access to those accounts, those are your accounts and you're welcome to have access to those, and we're happy to set that up. So if you're a treasurer or you're a board member and you want to have access to those accounts, reach out to your manager. We're happy to do that. An increase in the amount of owner assessments owed to the community, that could be an economic indicator that we've got a problem. And this is something that right now we are paying pretty close attention to as a management company. Obviously, as I mentioned earlier, when this pandemic first started, we were concerned that these delinquency rates were we were going to see an increase. With the amount of people being out of work and unemployment rates going up, those were definitely some indicators in 2008 and 2009 when we started to see increases. We really have not seen this happen yet, so it's something we're paying closer attention to. Communities that may start to see this occur in 2021 could potentially be communities that have a higher rental base. The moratorium on evictions and the grace being given to tenants could result in landlords not being able to ultimately, make ends meet there. So it's something we're paying close attention to as we move into 2021. We're watching those key indicators, but it's something as a board member that you should be aware of when you're looking at those reports every month. As an owner or as a board member, if you're ever buying in a community where there's an unusual amount of large legal expenses, that is an indication that you got something going on and you should understand that. Absence of a reserve study, if you're buying into a community that, would be a concern. I think most of all of our communities have reserve studies or have some form of that being tracked. Failure to resolve any differences between bank statements and financial statements. So your bank statements are always going to match your reconciliation, going to match your balance sheet. And if they're not, or if you're ever a part of an organization where they're not, you should be asking some questions. And missing financial statements, if you're not getting your financial statements, that's something that you as a board member should be concerned about. So what are some of the roles and responsibilities? As your management company, what are we taking care of? What is our accounting taking care of? Most of that is, sort of divided between our accounting department and our management team. And so, as your manager, we are overseeing the policies adopted by your boards. That means, we're implementing your budget. We're making sure those contracts are getting taken care of. We are overseeing sort of the administrative side of that, serving as those buffers between the boards and owners. And then the accounting team here at Appearing is really processing those daily transactions. We are processing your accounts receivable payments as they're coming in. We are processing your accounts payable weekly. So we use a system called StrongRoom. Some of you as board members may be involved in the approval process of that accounts payable. We're making sure that your tax records are maintained. We're collecting W-9s so that the 1099s can be sent to those organizations, here in January, February. We are overseeing your collections process from your adopted collections resolution. We're sending those initial correspondence to them. When they get to a point of escalation, that's when we're helping you send those over to the attorney and making sure that those processes are followed, really trying to make sure that your accounts receivable are collected. Assisting in auditing your financials, so we're providing all your information out to your outside CPA firm to review those, and processing, any ancillary billings that might come up. Do you have water? Do you have other expenses that we're reconciling and billing back to owners? So who is authorized to cut checks and who are the signatures? That depends on the community. And each community has the flexibility to set that threshold for themselves. So because we utilize a system called StrongRoom, Those accounts payable have the ability to have any amount of board member involved in that approval process. So most of our communities either have the treasurer looking at them, or maybe there's not a lot of transactions, so they delegate that to the manager. But once those go through our accounts approval process, we release those payments. And if we have board signatures on file, then those checks are signed by the board signature. Otherwise, they're signed by us as a management company for your master signature. So Carl, we might need to check your specific community and we can get you that information. But we have signature cards on file that are generally your president and your treasurer. And we have a lot of flexibility in our system to set what you want that specificity to be for your community. So if you want your treasurer to see everything, they can. If you want a second board member to see everything over a certain amount, they can. And so we have a lot of flexibility in how we set up that process and transparency for your community. So whatever your preference is how we can set that up. Important to understand that our managers and our employees are not CPAs. We are, essentially what you would consider a bookkeeper. We are processing your day-to-day accounting, but we are not credentialed CPAs. That is why you are engaging an outside firm to make sure that your taxes are filed, your financial review is looked at. If your community requires an audit, that is all done by a CPA firm. We do work pretty closely with CPAs. We do make sure that our internal security protocols and checks and balances really meet those generally accepted practices. So those have all been tested and our protocols have all been tested to make sure that we're complying with that. But it's important to understand that we are not CPAs. We are processing your day-to-day accounting and we are gauging with CPAs on the items that we need to. We are also not going to provide you with investment advice. We're going to help work with you and work with your community to understand, how your bank accounts are set up, what investment advice you might need, bring you professionals. If you need loans or things of that nature, we're going to bring those expertise to the table for you as a community. But important to understand that we are not acting as investment advisors, and we can bring the community that information should it be necessary. And just touching again, on some policies, as I mentioned, there's a lot of flexibility with how our system processes accounts payable. Your board of directors, if you haven't ever had this conversation, I would encourage you the next time you get together to chat about this. Who is looking at your accounts payable? Who do you want to look at your accounts payable? What are those thresholds that your board is comfortable with? If you have a pretty simple community and you're paying, the management company and the landscaper and an electric bill, it might not be necessary. But if you have a complex community that the board would like some insight into, the way that our systems are set up is it is very easy to provide the board with that. And then making sure that you have a policy about your accounts receivable. Do you have a collections policy on hand? How is your collections being taken care of? Who has the authority to write off late fees and interest? Is that delegated to the treasurer? Do we have some thresholds for management? Those are all sort of procedures and controls that you as a board should have some conversation about. And if you're a new board or newly elected, I really encourage you to ask those questions so you understand what some of those boundaries and thresholds might be. Another piece that is important to understand is your investment policy. So if you have a substantial amount of reserves that do need to be laddered or invested, it's always a really important idea to have an investment policy, and we can help you draft that. And that investment policy provides some guardrails for what are the objectives for the investment for the community, who has the ability to make decisions, how is it invested, and lays out a really clear understanding as to the approach of that. And again, you're somewhat limited, so this isn't a complex sort of corporate investment strategy or policy. It really is simplistic to say this is how we're going to invest our dollars, and this is who has the authority on the board to be making those decisions. And generally that looks like laddered CDs. You may ladder them 6 months, And 1 year, we're not really going out much beyond 1 year right now with CDs just because of low interest rates. And those CDs will come up. And so your investment policy will sort of lay out then who makes the decision on how that gets reinvested. So that is a lot of information that we just threw at you. So I will pause here, and you guys are welcome to sort of turn your cameras and your audio back on, and I am happy to answer questions that you might have about this information.
Katie, if I might just go back to my original question, and I'm not sure I was that clear. The question regarding sharing was like, with a website, are there certain services that you provide for us that we share with the other homeowners associations, maybe a pro rata expense or something like that?
I would say, the only thing that would probably come into play would probably be our portals. We leverage a software system that provides those online portals, and we, provide those out to the community. But for the most part, everything's fairly segregated. So the costs for sending mailings, those are directly attributed to individual communities. We try and leverage the size of our company to try and get you the best cost for those, but there's not really an instance of those shared expenses.
Maybe I should ask it. Thank you. Maybe I should ask it. Are we billed for anything other than what is included in our management fee payment to you? Would there be? Yeah.
No.
Nothing would be billed separately other than if we shared that expense in some way, shape, or form, it would be covered under our management fee. Is that correct?
Yeah. So, your management fee, we have a few consulting contracts, but most all of our management fees are structured as full management agreements. And we have a pretty short Schedule A of the things that aren't included in that full management agreement. So we can make sure that gets sent to you, Stephen. And if you have any questions about that, there's a very few instances of things that would be billed outside of that. Insurance claims are one of them. So if we're handling an insurance claim, that's not in our full contract. If we're overseeing a reserve project, that's outside of it, and design review. So those are kind of the three things. And design review costs are associated with remodels or new construction of homes. So just the standard processing of design reviews all included.
Okay, thank you.
Yeah, not a problem.
Katie, any personal guarantees involved with the gap loan or the bridge loans on the part of the HOA members?
So it's not a personal guarantee. The way that those work it's kind of an odd area of lending, honestly. And so the guarantee for those loans is the right to assess. And so what you sign with the bank is to say, if the community defaulted on this loan, the board has the right to assess owners to pay the balance of the loan. So it's not an individual personal guarantee, and it's really it's a transfer of power essentially to the board to say, if you defaulted, the board can step in and assess the owners.
Okay, thank you.
Mm-hmm. So Carla, it looks like you had a question about when is it okay to borrow from reserves to cover cash shortages versus bridge loans? I'm going to give you an attorney response and say it depends, because there's a lot of factors that would play into that we as your management company would kind of assess for you before we could provide you with some guidance on that. Things that we would want to look at is when are you going to need those reserve dollars? So if you're 20 years out from needing those reserve dollars and you need to borrow $10,000 to bridge that, and you can increase assessments over a period of time to pay it back, that might make more sense than trying to go through the cost of procuring the loan and paying the interest on that money and all of those things. So it really is going to depend on when you need the money, how much money you need, and how quickly the association can pay it back. Other questions? All right. Well, we really appreciate you guys attending today. As I mentioned, you will receive a copy of the PowerPoint presentation today in a PDF so that you can reference that. We also are putting these trainings up on our YouTube channel. So if you have other board members that weren't able to attend today and they would like to see the presentation, they can visit our YouTube channel and see some of those presentations. We are going to be doing these on the first Thursday of every month throughout the year, different topics each month. So your managers will be sending you those invites, and feel free to join us.